Hey everybody, welcome back to the channel. My name is Justin, and this is my favorite video series I do every single month where I talk about my favorite stocks to buy in the current month. So this is October 2023 edition. I'm going to be going over 3 different stocks I think that have really good value in the market right now. In fact, all 3 of these stocks I currently own, but one of them I actually recently started buying. So my strategy is I try to find companies that I understand what they do, the products that they make, or the services that they do, understand the industry. I believe that they have some kind of competitive advantage in the market versus their competitors. I also look into the management team, make sure that they're in line with the investors as well. And then most importantly, making sure I'm buying a stock that has a margin of safety. So I think the fair value of the stock is much greater than what it is trading at right now, because as an investor myself and other investors as well, when we're trying to find the value of a stock, there's a lot of assumptions that go into that. And for me, I look at different valuation templates. For one, I look at a discounted operating earnings model, which I'll be showing on each 3 of these stocks. I also look at a 10 cap payback method. All those come from Phil Town. His book here is right behind me. I took his investing course a few years ago, and I think that his investing strategies are pretty solid overall. So I try to use what I learned from his investing course, his books, also from other books I've read too, from Warren Buffett, Howard Marks, and then I try to tailor all that information and try to figure out how my investing strategy is. And if you guys don't know how to value a stock, which is one of the most important ways on investing strategy, whatever investing strategy you have, I do offer valuation templates on my Patreon. You also get access to my Discord channel and then the Patreon posts that I do as well on there. So I'll put a link down below if you're interested. But without further ado, let's just jump right into this in the first stock. And if you get some value out of it, please smash the thumbs up button. It really helps out the channel a lot. So let's jump right into it now. The first stock on this list is Raytheon Technologies, ticker symbol RTX. You can see a stock chart over the past year. It's been ticking up from around $60 a share, went all the way up to about 105, and then just you can see this huge tank, which we'll kind of talk about the challenges that are kind of going through right now, which created that decrease in stock price. And you will see a theme across all 3 of these stocks. I try to find stocks that maybe they're going through certain challenges, maybe they're going through an event that was their cause or maybe not their cause, but they're going to recover from. So a lot of times when I buy stocks, they're kind of on the downward fall. So it doesn't mean that they won't keep falling, but I find value in the stock price from where it's at. So currently it's trading around $70 roughly right now. Now, a quick overview about Raytheon Technologies. So they have 3 different segments of their business. They had 4, and they reduced that down to 3 here in 2023. But something to note is that in 2020, Raytheon Technologies and United Technologies actually merged together. So 2 huge defensive companies in the defensive market that have a lot of government contracts merged together. I'm actually surprised the government even allowed it to do so, because they're worth over $100 billion today as a combined company, which is just absolutely massive. So United Technologies owned Collins Aerospace, Pratt Whitney, and then of course Raytheon owned the Raytheon division here. Now, United Technologies, Pratt & Whitney is actually what we'll talk about in this video more than the other 3 because of the challenges that they're coming up with. But they make engines for Airbus and then also Boeing. That's kind of their biggest area there, mostly on the commercial side, not government contracts. However, Collins Aerospace, it has a lot of government contracts in it. And then Raytheon, which is a lot of the warfare missiles. They also have an aerospace division as well, which I worked within that aerospace division for quite a while. So I understand Raytheon, understand government, some contractors, and even prime contractors pretty well overall. But Raytheon is kind of more in the warfare and then the smaller aerospace division that they have. Interestingly enough, all 3 of these, which you'll see here in the next slide, are pretty close as far as sales go. So this is a 2022 adjusted sales number. So Pratt& Whitney was about $20 billion in adjusted sales. Raytheon was 25, and then Collin Aerospace was 23. So almost a 33% split between those three, which is kind of interesting overall. But Raytheon's a big company. Even though they kept the RTX ticker symbol and they're known as Raytheon, really United Technologies took over the business overall. All right. Some key takeaways from Raytheon and why I do like the stock, kind of where they're going. Management's committed to $33 to $35 billion of money going back to the shareholders through capital, whether that's buying back shares or dividends. And they're paying a really good dividend right now of over 3%. As far as adjusted sales growth, so their CAGR they think is going to be around 6 to 7% all the way out to 2025. They also think they're going to decrease some of their operating expenses, so they're going to increase their margins by 550 to 650 basis points, and they believe their free cash flow is going to grow to $9 billion by 2025. And here this year, they're expected to be between $4 and $5 billion on free cash flow. So they have a really, really nice run rate that they expect going out, and I do think they're going to be getting close to those numbers going out into the future personally. All right, so current challenges for Raytheon and the reason why their stock has taken a big dip over the last 2 months, it has to do with their Pratt and Whitney division. So Pratt & Whitney, again, makes the engines for the Airbus and Boeing as well. And unfortunately, they announced back in July that there were some powder coating issues with the engines themselves. So they had to ground a bunch of planes to check them out and get them fixed. Now, they didn't know what the total impact was going to be. They had an estimate, and they just came out here recently and then notated that's going to be a $3 billion impairment to their books this upcoming quarter. So that tanked the stock. Understandably, however, my personal belief is this is short term, and I believe that Raytheon has identified the issue, and this there shouldn't be a whole lot more of impairment around this specific issue going into the future. That's kind of my thought and my belief, and we'll kind of see how it plays out. But they're going to have to ground several hundred planes going out the next couple of years to get those fixed. But I do, again, believe this is a short-term issue. Now, as far as financial history, I like to show 10 years. I'm only going to show 3 years because of that merger. The numbers will just be skewed. In fact, some of the 2020 numbers are skewed anyway because that's when they merged. But nonetheless, their sales per share has grown 9% on the top line per year. Free cash flow has grown around 18%. Book value 1%. ROIC has averaged about 5% overall. What's really impressive is actually their debt situation is not that bad. You look at their debt; it looks massive, but this is a $120 billion company, certainly over $100 billion, and their debt equity ratio is 50%, which is excellent for a company this size. Their gross margin 20%, their operating margins around 11%. I think that's going to grow over the next few years. So their balance sheet's in pretty good order overall. Now, as far as a valuation for this company, I believe they're going to grow in the top line 9%. This is based on a sales per share number because I think they're going to continue to buy back shares. They've committed $30 billion of capital to the shareholders over the next few years, and I believe that's going to happen. I think their operating margins are going to grow to around 12%. So based on that, and a multiple of 23, which has been consistent with the market has paid for them in the last few years, I believe the share price is worth around $95 a share right now, which is about a 25% margin of safety. I typically like to have a larger margin of safety, but I understand Raytheon very, very well since I worked for them for quite a while. I understand the space really well, so I'm willing to buy in at this time. If it gets down to that $65 to $67 stock price, I would really start loading up at that time. But I do like where it's at right now. But always do your own assumptions. Again, I teach and have my valuation templates on my Patreon if you want to look at the link below as well too. Next stock up is Dollar General, ticker symbol GG. Stock price also has collapsed from around $250 a share all the way down to $100 a share, about a 56% drop. And very similar to Raytheon, they were going through some certain challenges, which we'll talk about here in a little bit. Quick business overview about Dollar General. They have 19,000 stores across the United States in 47 different states. They're kind of unique. So even though they're called Dollar General, most people think, oh, there's everything they sell is at a dollar, kind of like the dollar store. But that's not necessarily the case. A lot of stuff they sell is in the $10 range. But what's unique about them is that they serve smaller communities. So 80% of their stores serve towns of 20,000 or fewer people. So, the Walmarts of the world and other, companies in the retail space kind of stay away from these smaller towns or cities. But Dollar General says, hey, that's within our unique space. We're going to get into those areas and we're going to have less competition. And so what's interesting is that they're within 5 miles of approximately 75% of the U.S. population. So that's kind of their moat. So they have a lot of stores, but they're in kind of smaller cities, kind of smaller towns, where they're not going to have as much competition in there. Here's some more kind of stats about Dollar General: 170,000 employees. They have about $37 billion in sales in fiscal year 2022, 106 ranked on the Fortune 500 list. Fiscal year 2020, they had about $3 billion of operating profit, and their operating margins are pretty darn good compared to a lot of other companies that are out there. So for example, like a Walmart might be in that 3 to 4% range, where Dollar General has been almost double digits as far as percent wise. So pretty impressive overall. All right, some just more unique things about Dollar General. This is kind of what they strive to and what gives them their competitive advantage. Again, everyday low prices on quality merchandise, convenient locations, where we kind of talked about that, and then time-saving shopping experience. So one thing they've kind of tailored to lately is trying to find like kind of a treasury type search for customers that go into the store. So maybe their end caps, maybe that they have certain things throughout the store that might entice people to buy certain things. Kind of reminds me of Ollie's Bargain Outlet, if you guys know about that chain as well. That's kind of what they tailor to as well. So just a couple quick things. Now, current challenges for Dollar General, and they certainly are going through quite a bit here. So this is in their recent earnings announcement, where they're completely revising their outlook for fiscal year 2023. All right, so their net sales growth in the range of 1 to 3%. Now, it was 3.5 to 5%, so that is a big drop off overall. Same store sales growth, they said it should be around 1%, and before they said 1 to 2%, so that's dropped. Diluted EPS in the range of $7 to $8, which is a decline of 34 to 22%. So that has scared a lot of investors. So this is a company that we'll see here in a second that has been growing about 16% per year over the last few years, and that has completely come to not a complete stop. They're still growing, but they're not growing like they were before. So that has scared a lot of investors, and that's why the stock has dropped so much. Now, if we got a 10-year history, incredibly impressive with this company. So over the last, say, 3 years, 16% growth for sales per share, 17% for EPS. Now, free cash flow has taken a dump. And a lot of the challenges that they're coming up with right now is on their inventory. Their inventory has grown quite a bit, and they're trying to figure out ways how to get rid of the inventory without hurting their margins a lot, which is going to be difficult over the next year. So, and you can see their book value per share has actually been negative over the last few years. ROIC has been 12%, which is excellent. The one concern I do have about them is their debt. So their debt to equity, you can see here, has grown. So back in 2019, 45% debt to equity is incredibly good. Very, very good. Very similar to Raytheon, but it's grown to 319%. So that's not a good thing overall. I like to see that being around 100% or less. So that is a concern with their debt growing so much. So that's just something that I personally going to keep a close eye on going into the future. But nonetheless, the company has had some really, really good financial numbers over the past 10 years. They've averaged around 10% for operating margins, and the market has paid about a 19 multiple on average over the last few years for them. So pretty impressive overall. Now, as far as valuation for this company, I changed my valuation from last month as I kind of dug in more and kind of honed in more where the company I think is going. I've actually decreased their sales to about 6% on the top line. I think at 9%, but I think it's only about 6% over the next several years. I think their margins are going to be in the 9% range. Could be higher. I mean, they've averaged 10 to 11%, but I think it's being 9% based on a multiple of 16, which is less than what the market has been paying for them. I think the share price is worth 160, so almost a 30% margin of safety here today. So again, if you don't know how to value companies, I do offer that on my Patreon below. But always do your own research. These are my assumptions. Could be wrong, but I think that's kind of where they're at today. Now, the third stock I want to talk about is Tyson Foods, ticker symbol TSN. Very similar to the last two that we looked at. You can see the stock price going from almost $70 a share all the way down to around 47. Today it's trading around $50 here today. This is another company that is going through some challenges. And, you know, companies through their history are always going to go through some challenges one way or another. It's very unusual to find a company. I don't care how big the company is. Even Apple, as great as Apple is right now, go back in their history. 10 years ago, they had a huge fall off in their stock price. People thought that their sales were coming to a halt, and they got through these challenges, and they're here today at over like $2 trillion market cap. So companies go through these peaks and valleys. The important thing is, can they adapt? Can they turn around and and figure things out? And it really comes down to management. Can they get in the right direction overall, right? And so a quick business overview of Tyson Foods. Most people would recognize this company. $47 billion sales in 2021, $4.3 billion in 2021. I know this was basically 2 years ago, but I found this slide out of their investor presentation, which I thought was pretty good. Kind of explaining what the business does. 137,000 team members, 140 countries where they sell their products. So they sell primarily, beef, chicken, pork. They have different kind of prepared foods as well. And if you want to kind of know more about their brands, you probably recognize a lot of this. Obviously, Tyson brand here, Ballpark, hot dogs, Hillshire Farm, a lot of those, packaged meats. Jimmy Dean obviously is a big one as well too. So you can look across these, and a lot of these you're going to recognize. State Farms or State Fair is another one that I recognize. Bosco's as well. So they have a lot of recognizable brands in their market. And here's some, competitive advantage slide that I thought was really impressive. So number one in their frozen food, prepared chicken. Number one in frozen protein, breakfast. Number two in lunch meat. Number one in breakfast sausage. Number one in hot dogs. So you can see a lot of number one, number two in brands in their market. In fact, here's another great slide that shows their kind of market share within their different segments or brands that they have. So frozen nuggets, they own 42% of that market. Frozen strips, 37%. But what's most important is their next competitor. Look at that, 8%, 7%. So this is a really good slide to show how great of competitive advantage that Tyson has against their competitors and their top branded competitor overall. Now, here are their shortcomings or current challenges that the company is entertaining right now, unfortunately. So, on so they have beef, pork, chicken, kind of their main products that they sell. Beef and chicken, they've had some fallouts here in the last year. Their chicken production is going to increase approximately 3% for 2023, but their operating margins are going to be -1% to 1%. That's not good. They expect it to be in that 3 to 5% earlier this year, so that's a big fall off. Beef, they're going to decrease production by 3%, and their operating margins are going to be also -1% to 1%, and they thought they'd be in the 5 to 7% positive operating margin. So that is bad. But I do think chicken and beef We've seen even here recently, it's recovering. The issue is actually on the pork side right now. So they think it's going to be relatively flat for this year, and -4 to -2% operating margins. Not good when they thought they'd be positive going into this year. And that is a area where they haven't seen as much recovery from compared to beef and chicken. That's something we'll have to keep an eye on going into the future. Another thing is that they've announced a closure of 4 chicken segment processing facilities in 4 different areas across the United States. They do think it's going to cost the company about $300 to $400 million, but they're going to see some cost synergies over the next few years, not just from the shutdowns of these plants, but other areas too. And they think they're going to have $1 billion worth of savings going into the future. So it's short-term pain for long-term gain is kind of how I'm looking at that overall. Now, financial history for this company the last 10 years. You can see over the last 3 years, they've grown sales around 8%. They've had a huge hit on earnings over the last year, but nonetheless, over 10 years, they've had a 7% growth. Free cash flow, they can see huge hit over the last year. Book value per share still grown over the last 10 years, 12%, which is really good. ROIC is averaged around 9%. Their debt equity is 46%, which is fantastic. So their balance sheet is in excellent shape overall. The current ratio is fantastic, almost a 2. So their working capital is really good as well. The market has, on average, paid around a 11 market multiple for them, and then their margins have been around 7% to 8% over the last few years as far as the operating margins have gone. Now, as far as a valuation for this company, I think they're going to grow around 4% on the top line per year, so not a lot of growth there. Overall, and their operating margins are going to be around 7.5%, which is in line to where they have been. So the operating margins are only going to grow around 1% from my calculation. I think a multiple of 11, which is pretty conservative. It gets a share price around $73 for this company. So it's around a 30% margin of safety right now. So again, assumptions could be wrong, but I think there is a margin of safety in here that allows me to get in when the stock is down. I think there's some really decent growth going out into the future, and I think this is a good time to buy the company. They also pay a really good dividend, around 3% as well right now. All right, so those were the 3 stocks I wanted to talk about for October 2023. So quick summary. Raytheon Technologies, ticker symbol RTX. We talked about Dollar General, ticker symbol DG. Then we talked about Tyson Foods, ticker symbol TSN. All 3 of these stocks, I think, have a good margin of safety, but I think all 3 of these companies are going through challenges right now. So because of those challenges, we could see the stock continue to fall, all 3 of these, but I think they're short-term in nature, and I think long-term the management's got to figure out a way and get out of this for all 3 of these different companies. But I'm really curious from you guys. I mean, do you like any of the 3 companies? Do you own any of these 3? Which stocks are you buying October 2023? Love to hear from you guys down below in the comment section. I read every single one of those. I'll catch you guys on the other side. Take care and God bless.